Hey guys, welcome to the fifth lecture of the chapter Money Market and Capital Market in India, wherein today we are going to discuss the quantitative credit control methods. So let us learn one by one. The first and foremost very important and simple credit control method is bank rate. Now first of all I will explain the meaning, then I will explain in simple language how it works. I will explain its working also. So first one is bank rate. Now see what is bank rate? Bank rate means it is the standard interest rate at which our central bank lends long term funds to the commercial banks. As all of us know that if we individuals we are in need of funds, we go to the banks, we approach our banks. But whenever our banks they are in need of funds, at that time they approach our central bank, that is for India it is Reserve Bank of India, RBI, we call it as RBI popularly. So bank rate means it is the interest rate which the central bank charges while giving loans to the long term funds to the commercial bank. So whenever commercial banks goes for borrowing, they borrow loan from the central bank. At that time, whichever rate charged by the central bank, RBI, that rate is called as bank rate. I hope you got the point. Bank rate is the standard interest rate which the central bank charges while granting long-term funds to the commercial bank. I hope the point is clear. Now how this rate works, let us see that in simple language. Now this bank rate, it is used to manage liquidity, control overall money supply and curb or control the long-term inflation if it happens in the economy. Whenever the economy is going through inflation, faces inflation, then in that case to control that inflation, RBI uses or take help of this bank rate. Now how it works, let us see. Supposing RBI raises the bank rate, suppose this bank rate is increased by the RBI, then what happens is the commercial bank find it costly to borrow from the RBI. So the borrowing becomes expensive for the commercial bank. Borrowing महंगा हो जाता है. In that case what happens is the commercial bank want to maintain their profits. So what is done by commercial bank is they will pass on this burden of higher interest rate, they will pass on this burden to their consumers by raising the interest rate, because commercial bank themselves have to pay higher interest rate to the central bank. So to cover that, they will pass on this high interest rate, this higher cost to their consumers, whoever borrow from them. And this is done in the form of raising interest rate on various loans. Now commercial banks issues different types of loans. You must be knowing, like personal loan, business loan, commercial loan, different kind of loan, vehicle loan. So all these sorts of loans will be costlier to the customers also, and this is called as ripple effect. We call it as ripple effect in economics, we call it. Now due to this ripple effect, what happens is whenever the commercial bank raise the interest rate, then but natural common people like you and me, we people are discouraged to borrow more, because we feel that oh no, interest rate is very high, it's becoming costlier to borrow, and due to that the excessive spending and investment whichever is done by general public, that will be automatically reduced, that will reduce automatically, because due to the higher interest rate we people won't go for unnecessary buying, we will not do the unnecessary spending, and as such in the economy all these additional spending activities will be controlled, and thereby demand will be less in the economy, and hence as a overall effect ultimately the inflation will reduce and the price index will come down. I hope you got this point. I repeat in short once again. Bank rate, when bank rate is raised by the RBI, commercial bank feel burden to control the to cover up that losses or to maintain their profit. Commercial bank will charge higher interest rate to the general public. Then general public spending will be automatically controlled. They will not spend excessively. So ultimately, the excessive or unnecessary demand in the country, whichever is there in the economy, that will be controlled, that will be reduced, and hence as a result inflation will come under control. I hope the point is clear. Bank rate is over. Now let us move on to the second point. Second quantitative credit control method. Second one, CRR, cash reserve ratio. See, all of these factors actually they more or less work like same way. Cash reserve ratio, we popularly call it as CRR. Now what is CRR? CRR means it is the minimum percentage of total customer deposits, whatever are the customer deposits any bank is having, that total, that minimum percentage of that total customer deposit which commercial banks must hold as liquid cash with the central bank. Now let us take example. Supposing I am commercial bank, whatever 100 rupees, suppose I got customer deposits, then whatever is my customer deposits, out of that, suppose I have 100 rupee customer deposits, then out of that certain minimum percentage I have to maintain as liquid cash with the central bank. I have to compulsorily deposit with the central bank, and that is called as CRR. And moreover, central bank does not pay any interest on these compulsory reserves, on this mandatory reserve. We have to compulsorily maintain with the central bank. Currently, in the year 2026, RBI is maintaining the CRR at 3%. That means currently in the 2026 year, if I am a bank, I am having 100 rupees of customer deposits, then I have to compulsorily deposit 3 rupees with the RBI, on which I will not get any interest. I won't get any interest on it. I hope the point is clear. See, this CRR, these ratios keep changing as per the requirement of the economy. RBI sometimes increases it, sometimes reduces as per the economy's requirement. Next point, let us move on to the next tool, that is statutory liquidity ratio, SLR. See, what is SLR? Try to get the meaning first. SLR means it is the minimum percentage of deposits that Indian commercial banks must maintain in highly liquid assets. It's compulsory by law. SLR is the minimum percentage of deposit that Indian commercial banks must maintain in highly liquid assets. Now, what sort of assets? Such as cash, gold, or government securities, etc. Highly liquid. Immediately, it should be easy able to convert it into cash, near cash assets, cash, actual cash, gold, or government securities. Before lending to customers, that means whatever deposit a bank is having, they are lending it to other customers. So before lending, SLR has to be maintained. Now this SLR is prescribed by RBI, again Reserve Bank of India prescribes the SLR rate. This SLR acts as a crucial tool to control credit growth and ensure bank solvency. Now why this SLR is maintained by RBI, why it is prescribed? So that the bank should be always in a solvent position to fulfill the customers' heavy withdrawal requirements also. Suppose all of a sudden heavy withdrawal requirements come, then the bank should be in a position to pay back to the customer, and hence this SLR is maintained and it is prescribed by RBI. I hope you are getting the meaning. Now let us say how this SLR works and what is the current rate. Currently, the RBI maintains the SLR at 18%, 18% of a bank's net demand and time liabilities, NDTL. Now I would like to explain a bit here. See, demand and time liabilities means, demand means the liabilities which the banks have to pay on demand. Supposing I am having current account with the bank, I am having some saving account with the bank, and I am demanding back my money. Then bank has the compulsion to pay it back at any time on my demand. If I demand, I am getting back. That is called demand liabilities. And what are time liabilities? Time liabilities means, in shortcut we may understand it as FDs, fixed deposit. Whatever are the time liabilities, that means I am keeping fund for 3 months, 6 months, 1 year. So for a certain time period people are investing, those are called as time liabilities. I hope the point is clear. So the nowadays currently the SLR is maintained at 18% of the bank's net demand and time liabilities. So this ratio is calculated on the basis of NDTL held by any bank. I hope you understood this now. So the RBI is authorized to raise the ratio up to a ceiling of 40%. That means if required in the economy, then the RBI may raise the ratio even up to the ceiling of 40%. Banks keep these assets themselves. Now see, in case of CRR, commercial banks have to deposit that CRR amount with the RBI. Whereas here in the case of SLR, these assets are kept with the bank themselves and still they earn interest on the government securities they hold for the SLR purposes. I hope you are getting the logic behind it. See, the CRR rate is very small, that is just 3%. So the banks are okay with keeping 3% amount with the central bank without getting any interest on it. But the SLR rate is very high. The statutory liquidity ratio is 18% currently. So, but natural, it constitutes a big amount of their NDTL. Hence, the banks are keeping it to themselves, and moreover, the assets which they are holding for SLR purposes on such government securities, they keep getting interest also. So that they even keep earning the profit, they are not at loss. And they can work properly, they can function properly and make their profit margins. I hope the point is clear. So in today's lecture, we have seen the quantitative credit control methods. We have done with the bank rate, cash reserve ratio and SLR. I hope you are getting it. Because see, the working of CRR and SLR is as good as same as bank rate. Whenever the RBI wants that there should be more money in the economy, at that time RBI will reduce this CRR, reduce this SLR. And on the other hand, vice versa, opposite to this, if they want to take out money at that time, they will increase the CRR and SLR. See, in the first point, bank rate, I have explained in great detail so that you will understand the concept, how it works in the economy. I hope you got it. See, dear students, do watch other lectures, other chapters playlist uploaded on my channel, and please support me, guys. If you understood this little bit also, then make sure to like, share and please subscribe to my channel.